talking about an asset class that's hit a bit of a bump in the road recently. No matter what crypto asset you look at, prices are down 50, 60, 70%, or even more in some cases since last November. But unlike some areas of the market which have crashed and burned in 2022, crypto is an area that still has a lot of promise. It still has a lot of potential. And in fact, this year's decline in crypto prices, what some people call a crypto winter, could actually represent a great opportunity for long-term investors. That's what we're going to talk about today with the help of these three wonderful guests that are on stage with me. I'm Sumit Roy of ETF.com, and I'm going to help guide today's discussion. But before we get started, and we do have a lot to talk about, it'd be great if we could have our panelists say a couple of words about themselves as well as their firm. So why don't we start with you, Matt, and then we'll go down the row.
Sure. Hey, everybody. Matt Hogan. I'm the Chief Investment Officer at Bitwise. We're a billion-dollar crypto asset manager that primarily serves the financial advisor market, best known for creating the first and largest crypto index fund in the world.
I'm Rick Edelman. I built the largest RIA in the country with about $300 billion in assets, and now have launched DACFP, which is a crypto education company. We teach financial advisors about crypto and how you can talk to your clients and explain it to them.
And I'm OPHELIA. I'm the president of 21 Shares. We are the world's largest issuer of crypto exchange-traded products.
Okay, great. So crypto has been around for a while now, over a decade. Everyone in the audience, I'm sure, is well aware of things like Bitcoin, Ethereum, NFTs, maybe even DeFi. But it remains the case that unless you're involved in this space on a day-to-day basis, crypto can be quite confusing, right? I mean, there's a lot of jargon in the crypto industry. There's a lot of references to deep technical computer science, which you might not know about or you might not even care to know about. But if you're going to invest in crypto, it's important to understand it at least from a high level. And crypto isn't just digital gold. It isn't just digital art. Those are two popular use cases today, but there's potentially millions of use cases for crypto, many of which haven't even been thought of yet. The way I like to think about crypto and blockchains is this. It's a computing system that isn't owned or controlled by a single entity. And because of that, it opens up a ton of new applications and new assets that wouldn't be able to exist before under a more centralized system. Now, that's just one way of thinking about crypto. A lot of people have talked about how it's the internet of value or property rights system. I want to know what our panelists think about crypto at a high level. How would you describe crypto? Why don't we start with OPHELIA, and then I also want to hear from Matt and Rick as well.
I think I get the easy one because I get to go first. Crypto can be a very wide range of things. So I actually don't like to define crypto altogether. I think it's actually far more important to split things up by use cases. And there are typically like three major categories that we think about. You've got cryptocurrencies, things like Bitcoin that are meant to be a store of value. You've got smart contracts platforms broadly, things like Ethereum that are meant to be basically a supercomputer. And then you have tokens, which can do a very wide range of things from art to decentralized finance. And I think when you look at the ecosystem holistically, you sort of lose some of that nuance. So that's at least the definition I work with.
To me, it's all about practice management. It's all about overcoming the challenges that advisors have. And we all know what they are. You're struggling to differentiate yourself in the marketplace. You're struggling to get more clients, more assets, build your business. So for me, Bitcoin, it's not a payment system. It's not a transfer of wealth system. It's not a store of value. It's not software. Bitcoin is a marketing opportunity. It's as simple as that. It's a way for you to differentiate yourself from other advisors in a unique way that is unlike anything else we've seen in the financial services industry, that allows you to demonstrate a new opportunity for creating value for your client, reminding them of why they hired you, a way for you to set yourself apart from other advisors who are clueless about crypto. And the sooner you begin to realize that this is a marketing opportunity that can allow you to attract more clients, collect greater wallet share of the clients you do have, increase your AUM. It has nothing to do with liking Bitcoin. One of the events we teach in our courses is how to build your business by hating Bitcoin. It's simply a function of understanding this asset class because it's unlike any other, and recognizing it for the business building tool that it really is. It's a marketing opportunity, and once you get that mindset, your eyes will open to what 21 Shares and Bitwise are offering you, because they're giving you the roadmap to helping you integrate it into your practice so that you can use it for building your business, which is at the end of the day what you're trying to accomplish.
I love that. It's hard to add to those two. I would start by saying what it's not. It's not a new way to buy a cup of coffee. One of the things about crypto is there's so many people who reflexively are skeptical of it. And I think the reason, Sumit, that they're reflexively skeptical is because they think of it as a cryptocurrency. They've never seen someone buy a cup of coffee with it, and they wonder how it can be worth $1 trillion. So I think the first thing advisors should do is tell people it's not a way to buy a cup of coffee. It's a technology, as OPHELIA mentioned. It lets you do 3 things. It lets you move money at the speed of the internet. It lets you program money like software, and it lets you have digital property rights. And you can stack those 3 capabilities together and do incredible things. And then as an investor, it's one of the few asymmetric assets you can invest in as a retail investor or retail customer. An asset where the most you could lose is 100%, but you can make 10x your money. It's one of those few things that most people have access to. So that's what I would add. What it's not, a way to buy a cup of coffee. What it is, a technology with these capabilities. And as an investment, an asymmetric potential investment to add to a portfolio.
Matt, you mentioned $1 trillion, the crypto market cap. Of that, 2/3 is Ethereum and Bitcoin alone. I think we should touch on both of those assets and start with Ether because it's such a big week for the Ethereum blockchain. I think sometime between Wednesday night and Thursday morning, there's going to be a major software upgrade to the Ethereum network. Who wants to talk about that?
I guess I can take that. So software update is referred to as the merge. It is the single largest software update that's ever happened, certainly in Ethereum and honestly in crypto. The idea is we're moving the way the operating system that is Ethereum is moving from a certain type of validation to a new one. It's never really been done. People have been working on this for years. The benefits of this are we're looking at significantly reducing inflationary pressure within Ethereum. So you're going to be looking at more scarcity in the asset. It changes the way consensus is reached. So you're dealing with a lot of like the questions around energy intensity, and it moves us away from some of the centralization that had been occurring within the network towards a more decentralized reality. And this is something that's been in the works and people have been discussing for years. It's probably one of the most exciting new innovations in crypto. I think probably we'll see this year, if not for the next couple.
But let's translate why that is such a big deal and so much excitement in the crypto community about it. It's going to take away a major objection that institutional investors have had as to why they have not been engaging in Bitcoin or blockchain. And that is the accusation that you've heard so many times that crypto is bad for the planet. It uses this intense computer energy that throws off all this CO2 into the atmosphere, and in today's ESG world, it gets a lot of criticism. Ethereum's change that is occurring this week is going to cut the energy usage over 99%. It's going to remove one of the biggest objections that the institutional market has faced in their willingness to invest in Ethereum and engage with it as a corporate tool for building a business. With that out of the way, this sets the stage for massive new levels of institutional engagement, which many argue is therefore only bullish for the price of Ethereum, and ultimately expected that Ethereum will overtake Bitcoin in market share and become the dominant coin in the future. So this technological shift is, a lot of folks are just very bullish about it because of what it means for engagement.
Yeah, I would just add one thing. The other shift that's going on is institutional investors who used to only think about Bitcoin are now thinking about Ethereum as well. If you think about the institutions that came into the space in the last bull market, most of them were Bitcoin only. through NYDIG, through Fidelity, et cetera, people are now realizing that Bitcoin and Ethereum are as different as Google and Salesforce, and you can't have a portfolio of just one. And so I think that's a massive change. It's catalyzed by the merge. And then the other thing I would add, Sumit, is this is not the end of Ethereum's technological journey. The next step after the merge is adding scalability, which to me is a bigger deal. Ethereum can only process 15 transactions a second. A few years from now, that'll be 100,000. When people talk about when will crypto go mainstream, you have to recognize the technology is improving so fast, and the merge is just, it's really exciting because it's right now, it's the biggest technological change in crypto's history, and there's more to come down the road, which is really exciting.
Matt, I want to ask you about staking in a second, but Rick, I know we've talked before, and you're pretty positive on Ethereum because it's this general purpose smart contract platform, and it's at the center of a lot of innovation with DeFi and NFTs. Can you go a little bit more into that?
Sure. The problem with Bitcoin is that it's dumb. If I send you my Bitcoin, you receive it. I might not want you to. I might want you to get my Bitcoin only after you do something for me. And you really can't accomplish that in Bitcoin. That's a big reason why Ethereum was invented. Ethereum is known as smart contracts. It's programmable money, meaning I can send you my Ethereum and you receive it only upon an event, such as you giving me concert tickets with a deed to your house, or if somebody wins an election, or the Super Bowl. It's an if-then contract, and contract law is how business operates on a global basis. So the ability to program contracts into software, taking out the middleman, the intermediary, the title settlement company, the attorneys, the brokers, allows business to operate faster and cheaper than ever before. And the applications cut across every sector of the global GDP and every commercial application of business in the world. And that's what is really making Ethereum so exciting. Its practical application is bigger and broader than Bitcoin.
So Ethereum, obviously a very exciting and powerful blockchain. And at the center of that is Ether, the cryptocurrency. And Ether is a very multi-dimensional asset. Every time someone makes a transaction on the Ethereum blockchain, it costs some Ether. Some of that Ether is removed from circulation or burned, and some of it flows through to validators. So in that sense, some people call Ether somewhat like a commodity, but at the same time, you can hold it like a store of value, and you can stake it and generate some Ether rewards. So in that sense, some people call Ether a triple point asset because it has these characteristics of a commodity, a store of value, as well as a yielding asset. Can you talk a bit more about that, Matt?
Well, I think that's exactly right. I think of Ether like I think of real estate, right? Real estate is a store of value and a useful asset, and I can rent out my house on VRBO and make money. So it has all the same characteristics. If Bitcoin is digital gold, I think Ethereum being digital real estate is like a good mind space to be. The yield thing is really interesting because after we go through this transition from proof of work to proof of stake, and I'm happy to explain that if the audience would think it's interesting, long-term investors in Ethereum will be able to earn a yield that we at Bitwise estimate will be in the 4 to 8% range for staking their asset. That adds another characteristic to the investment, which I think is really exciting.
And it's fundamentally uncorrelated yield because it's actually yield that's being created through a completely different mechanism. We've been offering products that have staking baked into them on other networks for years, and they are some of our most popular products specifically because it lets you capture yield in a way that's not tied to bond markets or whatever the Fed is doing today. And I think that's an element, especially when you think about it in the construct of portfolios and in the construct of investment advice, it's a critical piece.
Yeah.
And just to illustrate how new and different and innovative this is, the IRS doesn't know how to tax it. There's a lawsuit going on right now to resolve this question, which we're figuring next year, if we're lucky, this case will be resolved. So the fact that it is so new and different that even the IRS doesn't know what to make of it illustrates that you really need to learn about this stuff because it offers opportunity and has implications for portfolio management and tax management that you need to become fluent so that you can more effectively guide your clients. The fact that it offers a new and different way to generate yield in today's interest rate environment is really, really important for clients who are income oriented.
So let's turn now to Bitcoin, which is the asset that started it all. Ophelia, have you been surprised with the way Bitcoin has acted this year, in a year in which we have 40-year high inflation? Some people considered Bitcoin to be this inflation hedge. It hasn't quite acted like that.
No. I think there are a couple of things about this asset class people often miss. This is sort of like investing in the base protocol that is the internet. If you look at a web domain on your laptop, you see that HTTP, the beginning of it. Most crypto that we're investing today is various iterations of that. And so I think you're still dealing with a very risk-on asset, especially in this environment. That being said, we're looking now at these very depressed prices that people are concerned about, but this is significantly above what all-time highs were from the last bull market. All the fundamentals, all of the things that actually provide value within the network are showing incredibly positive signs in terms of growth in the community, growth of utilization rates, increase in smart contracts calls. People aren't just trading this stuff in a speculative way, they're actually building. And I think sometimes the narrative around inflation obfuscates a lot of what is still needed in this space, which is one, easy ways for people to enter the space, and clear ways to build your knowledge base, build that education, have people engage, as well as some, quite frankly, like markets infrastructure that's still not quite built out. And I think taking all of those pieces into account, this is still a volatile asset class. It's not terribly surprising.
I think people don't buy into the Bitcoin inflation narrative, but actually the data would say it did a fantastic job. So I'm going to push back on the premise of your question. If you think about Bitcoin's returns post-COVID, it went straight up from March until November of 2021. And that was the period of massive quantitative easing and fiscal stimulus. And then the November Fed meeting was when the Fed retired the word transitory and talked about switching to a rate-rising environment. Bitcoin fell exactly, or within a few days of that meeting. And I think what that tells you is Bitcoin is a hedge of future inflation. And what Bitcoin is telling you now is that the Fed is going to grind inflation into the ground. I actually think it did a good job. You can't expect to hedge CPI because it's a backward-looking thing. I think Bitcoin did well when inflationary pressure was building and the Fed was a constant put in the market. And then once it switched to quantitative tightening, Bitcoin fell backwards. I actually think it did spectacularly well, and it's still up 3 or 4x from where it was at the start of COVID.
Interesting. I haven't heard that take before. Rick, so we've established that crypto is this groundbreaking technology with a ton of potential, but there's a lot of technologies out there like that. How come advisors should care about this technology specifically?
For exactly the reason that you just mentioned, we need to recognize that this is one of the exponential technologies that we're seeing invent. This was the basis of my book in 2017 called The Truth About Your Future, which is all about XT. It's all about robotics, artificial intelligence, big data, 3D printing, nanotech, biotech, bioinformatics, fintech, edtech, agtech. All of these innovations, which are fundamentally based on computer technology, are what's driving the future. And blockchain and digital assets are among that category. So if you're going to tell me that you believe that it makes sense to allocate a small portion of a client portfolio to robotics or 3D printing or artificial intelligence or machine learning, then how can you not add blockchain and digital assets to that list? And you don't need to do 30, 40, 50% of the portfolio in this. You treat it as a thematic approach to the portfolio, and low single digits are plenty, just as you would do in real estate. I don't know too many advisors who tell their clients to put 60% into real estate, but you'll routinely do single digits, and crypto belongs in that category for the very same reason. To say no to crypto, to be at zero, you're likely going to be 100% wrong, and that's really what you need to come to grips with.
Awesome. So my next question is also shared by this one question from the audience member, and it's essentially, how do you go about adding crypto to a diversified portfolio? Is indexing the way to go? What do you think, Matt?
Well, you're asking me to talk my book. I run an index fund. Of course, indexing is the way to go. Look, I think this is an early stage disruptive technology, and it's frightfully difficult to forecast exactly how it will turn out. I have a high degree of confidence that crypto and blockchain will be much more important in 5 years than they are today, and a much lower degree of confidence whether Cosmos or Cardano or Solana or Ethereum is going to win the war. So for me, adding a diversified exposure to crypto makes a great deal of sense. There are, of course, good active managers out there. I think just adding Bitcoin at this point is a mistake. I think you need to be more diversified than that. But whether you find a high-quality index manager or a high-quality active manager, I think those are both important. The thing I would add is, as Rick said, the most important thing to do is to size your portfolio in the right way and to invest for the long term, because this is a volatile asset. But there are, of course, good index solutions out there from Bitwise, from 21 Shares, and from others.
And we've seen the data actually bear this out. Our index products, I think the first product we ever brought to market was actually an index also. And one of the interesting things we've seen over the years has been we went from a deep interest in single names, mostly Bitcoin. Now we're seeing much more interest sort of along that long tail and a much deeper understanding of that long tail, especially when you start to think about things like DeFi. That takes a lot of research. And it's very difficult to pick medium to long-term winners. It's a lot easier to trade the sort of short-term news cycle in crypto. And I think for those reasons, unless the plan is to actually go deep into each of these assets and make very thesis-driven investments on each one based on their fundamentals, indexes are the way to go. And it's by far what's more popular with our clients.
And this is why I get a little frustrated when advisors pretend that they don't know how to do this, because you do it all the time in the stock market. You know how to diversify, you know the importance of it, you know the benefits of broad-based investing through ETFs and index funds, you know how diverse the stock market is, which is why you own growth and value, and you own US and foreign, and you own so many different aspects of the marketplace. Crypto's the same thing. Crypto is as diverse a marketplace as the stock market is. You know the value of diversification, and you know the hassle of picking individual stocks, which is why you use ETFs instead and index funds. So just do the same thing in crypto. You don't have to become a crypto manager any more than you have to become a stock manager. You offload that chore to the funds, and that's what these two companies do so well. So they deal with the minutia, the day-to-day operation of the portfolio allocation, so you can do your job of serving your client. So just treat crypto portfolios the way you treat a stock portfolio. You're much better at it than you're giving yourself credit for.
And Matt, have there been studies, or have you done studies on how much crypto exposure is optimal per portfolio?
Yeah, we did do a study. I was fortunate enough to write the CFA Institute's guide to crypto. It was included in that. What we found is that most investors are best served between 1% and 5%. The thing that happens once you get above 5%, it still historically improves your Sharpe ratios and your risk-adjusted returns. But once you get above 5%, crypto becomes the primary driver of maximum drawdown in your portfolio. And maximum drawdown, in my view, is what retail investors feel in their guts. And so if you get above 5%, crypto is the primary driver of that, and I think that increases behavioral risk. People will panic and sell when this market inevitably goes down. The average Bitwise client's about 2.5%. On our advisor side, it's probably closer to 5%. The institutions are a little bit lower, but somewhere in that 1% to 5% range, I think, is the magic number.
And this is why, if I can pile on my comment earlier about why I believe crypto is a big marketing opportunity, it's actually a fulfillment of your fiduciary obligation. And that's what makes it a great marketing opportunity. Because what we discover is that most advisors are not engaging with their clients in crypto, which means your client is going somewhere else to get it on their own. Your clients are buying Bitcoin just like your teenagers are drinking beer. They're not telling you, but they're doing it. And the fact that they're doing it without your engagement means they're probably doing it wrong, meaning they're probably buying too much, or they're getting it at a platform that's too scary. unregulated, perhaps offshore. Maybe it isn't even Bitcoin or Ethereum they're buying, but some wacky token that is on the fringe that has no legitimate basis in a portfolio. Your lack of engagement is contributing to the client's risk of losing a lot of money by having too much exposure. And that's why it's a great marketing opportunity to say to your client in a review, tell me about your real estate. Do you own a vacation home? I didn't sell it to you, but I want to know that's market value and the size of the mortgage and the interest rate and the monthly payment. Tell me about your life insurance. I didn't sell it to you, but what's the death benefit? Who's the beneficiary? Tell me about your annuity. I didn't sell you that either, but I need to know about it. Tell me about your 401k. I'm not managing it, but I need to know the allocation. Tell me about your crypto. I didn't sell it to you, but I need to ask you, what's the platform? Which coins do you own? What percentage of your total net worth is in it? Who's the ownership? Does your spouse know about where it's being held? Because if you die and they don't know the password, it's as good as gone. Have you incorporated it into your estate planning documents? Do your job as an advisor. You'll demonstrate greater value to your client, and by using your fiduciary responsibilities, you're demonstrating through a marketing activity that you're building your business without ever actually saying to your client, I think you should buy Bitcoin.
And there's a huge difference between those things. And if you think about, even natively crypto wealthy people today don't get that kind of service, actually.
Right.
People don't ask them those questions. And so whether they're using, products like ours or like Bitwise's to actually bring those assets within more traditional rails, or whether they're holding them themselves, it's actually really difficult to have anybody treat that as part of your broader financial picture. So I completely agree with that. We see it a lot with our clients in helping them build that understanding and helping them build a vocabulary to communicate with their clients and with their counterparties around these types of investment products. It's critical.
Let me give you just one tangible, practical application. Most advisors are not aware of this. Bitcoin and Ethereum are not subject to the wash sale rule, which means your client, who's probably lost money over the last 9 months in their Bitcoin, if they bought it over the last year or two, you could have them sell their Bitcoin, capture the tax loss, and immediately rebuy it. They don't have to wait 30 days. Your client doesn't know this. And if you call your client on the phone, send an email to your whole book saying, do you own Bitcoin and Ethereum? Because if so, I can save you thousands of dollars in taxes this year without taking you out of the market. You'll immediately demonstrate value add to your client in a way they had never considered. And it has nothing to do with whether you're endorsing or recommending the asset class. So the more you learn about this, the greater value you'll be to your client, you'll fulfill your fiduciary obligation, and oh, by the way, you'll be creating a new marketing opportunity for yourself.
There was a great question from an audience member who asked, because staking rewards are going to be a big thing in the future, are you better off direct indexing rather than buying a fund? Because I'm not aware of any funds that are going to pay out those staking rewards. So
actually, all of ours.
We
have
do
products that do this,
okay.
and we've had that for years.
Okay.
In Tezos and in Solana, we just essentially roll the staking rewards back into the principal of the ETF and then stake it again.
That's awesome.
So you're actually getting that compounding inside of our Tezos and our Solana products. Hard to do with Ethereum now and immediately post-merge because it's not liquid.
Yeah.
But once there's sufficient liquidity in it, absolutely, you can do stuff like that. And in fact, it actually simplifies a lot of your tax issues because essentially you have the fund that's managing that tax liability on behalf of clients instead of needing to have it run directly through your client's tax returns.
Yeah, I would just add staking's not trivially easy, and many staking service providers are not institutional grade. So there are real risks to doing it yourself as well. And I think you'll see all funds move. 21 Shares has been a leader for sure in terms of staking assets for clients and rolling it into fund returns. It's a service fund providers should provide.
And it's something that ultimately you get a lot of questions, I think, about direct indexing and about direct holdings of crypto versus fund structures. It's things like this, right? It's ultimately tax, infrastructure, reporting, and a little bit of that simplicity to actually bridge traditional financial rails and crypto that actually make these products so valuable.
That, and I would add risk mitigation as well. Index providers may seem simple on the outside, but did you hold Luna? Right, is a good question. Did you hold Dogecoin, et cetera? There's actually a lot of risk and analysis that goes into running an index. They're not S&P 500 style indexes.
And this question kind of reflects the skepticism a lot of people have about Bitcoin. The audience member asked, we can't use Bitcoin to buy coffee. What can you use it for, especially in comparison to other crypto assets, which can do more tangible things?
Well, the first thing I'd say is you can donate it. So if you bought Bitcoin over the last 10 years, other than the last year and a half, you've probably got some pretty strong unrealized gains, and donating it is a very tax-efficient way to dispose of your crypto. And in fact, the data is telling us that crypto investors are among the most philanthropic in the country. The average crypto holder donates far more, a far higher percentage of their net worth than non-crypto holders. So that's one thing you can do with it. But the main thing to really answer your question is if you're not going to use it for a payment, you're not going to use it in a transaction, then it goes back to the point Matt made of digital gold. It's a store of value. You're buying Bitcoin because you believe it's going to rise in value. And the fact that you can't do anything with it is kind of like the same thing of a gold coin. You can't do anything with that either, but you're going to buy it for a different reason.
Yep, I agree with that. Bitcoin's digital gold with a call option, an out-of-the-money call option on monetary use cases. But as digital gold, it's easy to argue your way into thinking it's worth hundreds of thousands of dollars if it's successful. My view of the current Bitcoin price is it's wrong. Bitcoin's either going to be successful, in which case it's a 6 or 7 digit asset, or it's going to be a failure, in which case it's a 4 or 3 digit asset, and it's unlikely to stay in this intermediate middle. The bet you're making is it's going to be a form of digital gold and maybe have edge monetary use cases in difficult regimes and deeply inefficient parts of our financial ecosystem. And that's what it's useful for.
And the Federal Election Commission now says you can donate it to your favorite political candidate.
Yeah, I agree with what both of you guys are saying. I think when you think about Bitcoin, and one of the most interesting things that I've seen in the past year, for the first time, and when we started the company, crypto was not cool. No, people treated it like we were trying to securitize, I don't know, nuclear weapons and sell them to them as if they're candy. And one of the most interesting things that's happened is that people don't really ask if Bitcoin's going to zero anymore. Is it going to fail? Is the network going to fail? What happens? How do you think about security risks? How do you think about a lot of those questions that were so core the first several years of certainly my company's life? You don't get them anymore. And that's a radical shift that, to me at least, would indicate you're more likely to end up with a success story than a failure, if only because fundamentally people are starting to get it and see the role that it can play in portfolios and see the role that it can play in monetary policy, and quite frankly, realize how impactful monetary policy can be, given that we've lived in such sort of placid times for the last decade or so.
So ask yourself where you are in that timeline. In the beginning, the question was what? What is Bitcoin? And then it became why. Why should I care? And now many advisors are in the how. How do I invest? How do I build a portfolio? What investment products are available? Some are now going beyond the how into the can't. Their compliance officers won't allow them. Their firms won't permit it. And that's kind of where we step in with DAC-FP, is helping you craft a crypto strategy that is compliance safe, that is permitted by the firm, and helping advisors get past the what and why and into the how, because you'll discover it's incredibly easy today, thanks to firms like 21 Shares and Bitwise that didn't exist as recently as 5 years ago. It is now amazing how easy it is for you to allocate for your clients in a compliance-safe way that isn't disruptive to your practice. The bottom line is this: you don't have to change your practice for crypto. Crypto has changed to accommodate your practice, and that's what you need to realize.
And it's a lot of these issues, quite frankly, as to why products like ours have a reason to exist, and why these companies were built in the first place. My mom was trying to buy Bitcoin in 2014. There was no infrastructure to do so. There was no way I could tell her, even though, hey, yes, buy this, you can invest, it will be fine, this platform is safe, this will work, no worries, you can do this. There was no infrastructure with which to do that at all. And that's certainly not where we are today.
This audience member is concerned about custody. How are the big players protecting themselves and the clients? What would you say to that?
The short answer to that is the institutional custodial market has improved just dramatically over the last 5 years. There are now a number of highly regulated, well-established institutional players, whether it's Fidelity or Anchorage or Coinbase's institutional business, that do an exceptional job. You still hear about hacks, but they are entirely at the local individual user level, carrying around crypto in a hot wallet. The institutional custody space, I think, right now is robust, well-established, and we don't get a lot of questions about that anymore from clients.
And maybe add insurance to that,
And
which a
insurance
few years
helps.
ago you couldn't get either. So the interesting thing for us on the infrastructure side is that it's constantly changing, and so there are a couple of players that are consistently like up to snuff on best practices. They're the bleeding edge of what you can do in terms of security, and it's part of, quite frankly, like building responsible investment products is staying on top of those types of advancements. And I think I agree with you about the broader institutional custody space is in a much different state than it was a couple years ago.
Just the insurance is a great point, because if you think about it, they wouldn't insure it because they didn't
Yeah.
understand the risk and they couldn't quantify it. And now the largest insurance companies feel comfortable saying it's contained, it's this big, otherwise we're fine. I think it's really a signal.
We got someone that suggests that even though crypto is supposed to be this uncorrelated asset, recently at least, it seems to be moving in tandem with the broader technology sector, particularly, the NASDAQ and things like that. Do you think that's going to change, or is that just a 2022 phenomenon?
It's too early to tell. For the moment, it's a relatively recent phenomenon. It wasn't true for the first 11 years of Bitcoin's life. It became true in the last year. I think coincident with the institutional investors who are new to crypto, and when they started selling off last fall and winter, they just indiscriminately sold off everything. So everything's down, stocks, bonds, crypto, and it's like they didn't get the memo. This is a different asset class. You shouldn't be treating it the same. And I think that over time we will return to the fact that it's a non-correlated asset, but for me at least, I think it's too early to tell.
Yeah.
One of the things to add to that is why, a lot of the market forces affecting crypto, some of them are consistent across the market, but some of them are quite unique, right? There was a couple of black swan events that happened that were native to the crypto space that coincided in time with some very meaningful things happening in the rest of the world, but they have absolutely nothing to do with each other. Like Luna and rate hikes are not really in the same basket of problems, they just happen to have happened at the same time. And I think we're also seeing a little bit of that in the market right now.
Yeah. I think we'll get back to low correlations. My mental model for crypto returns is there are three drivers. There's the macro driver, the sector driver, and the asset driver. So like Ethereum's being influenced by the merge, but there are also regulatory issues. There are also macro issues. For the last 8 months, we've been in a macro-driven market, right? Tesla's not trading based on how many cars it's manufacturing. It's trading based on how aggressive the Fed is. That's been true of crypto, but we'll get past that. And the secular drivers of crypto, which are not correlated with the stock and bond market, will begin driving it again. For what it's worth, SUMIT, we've seen it before. Same thing happened in Q4 of 2018 during the mini taper tantrum. Correlation spiked, and then they returned to basically 0.1, 0.2. And I suspect that's what we'll see as we get into next year and beyond.
Since we're on this topic, I'd love to get your take on crypto tokens versus crypto-related equities. I know you have products in both spaces, Matt. What are the pros and cons of each approach?
It's similar to the pros and cons of gold miners versus gold. One is easier to value and has profits and earnings, etc., and one is a more direct exposure. The primary advantage of crypto equities to advisors is in the US, you can buy them in an ETF. So you can buy a basket of crypto equities in an ETF, and it fits right into your practice, and it has a high correlation to crypto. I also think those stocks happen to be underloved and tend to be undervalued, but mostly it's a proxy way to gain exposure for advisors who are more comfortable doing that than buying Bitcoin directly.
Any insights on that, Rick, as from an advisor perspective?
No, I think Matt has said it just fine. I really don't have much to add on that.
Awesome, awesome. So we have about a minute left. I want to end with this question. Obviously, NFTs were this huge phenomenon in 2020, 2021. A lot of it was digital art and pictures of, apes and things like that. But I know the NFT as a technology is much bigger than just digital art and collectibles. Matt, we talked the other day, and you told me there's so many other use cases for this technology. Could you talk about that briefly?
Yeah, I think NFTs are the biggest digital primitive that crypto has created. I think music NFTs are going to reshape the music industry in the next 5 years. Music NFTs allow you to buy the streaming rights to a song of your favorite artist. Imagine how much cooler it is to have bought the streaming rights to Radiohead's early albums rather than just having a t-shirt. I think that's going to be one of the first mainstream use cases. And I think we're going to see NFT use cases everywhere. Remember, when you say NFT, don't think Bored Ape. Think digital property rights. It's a massive, epochal, generation-shaping idea. And I think it's going to roll out in lots of different ways.
Everything's going to be tokenized by the end of the decade. Your driver's license and your passport will be an NFT in your digital wallet. Your employment records, your medical records, your academic records, all of it is going to be digitized. The deed to your house, your salary, everything's going to be digitized. And that's going to be the stepping stone into the metaverse, which is a whole nother conversation.
From a technology perspective, it's probably the most differentiated thing that a blockchain can provide aside from decentralization. And that's quite undervalued in this market. Bored apes are great, don't get me wrong, but it is a small part of the market, and by the way, operates a lot like the art market. So to the extent your clients are interested in that, that's great, and people can make lots of money doing it, but that's certainly not the be-all and end-all.
And this is why you need to become fluent in all of this stuff so that you can be of greater value to your client, and along the way, you'll make more money and run a better practice.
Fantastic. We're going to have to leave it there. Thanks so much to our 3 panelists for sharing their insights.
Thanks, everybody.
Thanks, everyone.
Thanks.